It's in the short term, it's probably unclear if it helps or hurts Bitcoin because Bitcoin also is correlated with global monetary liquidity. Raoul Pal at Real Vision put up this chart years ago that shows M2 versus Bitcoin, and it's been almost dead on at all the bottoms and tops.
This creates a supply squeeze unlike anything in traditional markets. If you think about trillions of dollars of institutional demand at pension funds, insurance companies, sovereign wealth funds, and even central banks competing for a tiny fraction of available Bitcoin, you can see how the price could leap dramatically. Tom Lee argues this is why Bitcoin could replace gold as the primary non-sovereign store of value. Gold's market cap is about $22 trillion. If Bitcoin were to reach that level, we'd be looking at a price point of around $1.2 million per coin.
Bitcoin has done very well over any 10-year period, and at $100,000 today, it does reflect that institutions are beginning to view this as a legitimate way to store value. Because the Bitcoin blockchain is really one of the best ways to record financial transactions with 100% never failed censorship resistance, never fraudulent entry in its entire operation. So, but institutions, only about 5% actually own any Bitcoin, but 95% of Bitcoin has already been mined. It's a fixed supply. That's a stat from Bitwise. But that 5% that isn't held yet, because the other Bitcoin is basically being hodled, has to be acquired by those 95% of institutions. Plus now governments want to own Bitcoin as a strategic reserve. So if you think about how difficult it is going to be to acquire that last 5%, I can see why it would replace gold or equal the network value of gold, which is over 22 trillion, and that would put Bitcoin at around 1.2 million. It's in the short term, it's probably unclear if it helps or hurts Bitcoin because Bitcoin also is correlated with global monetary liquidity. Raoul Pal at Real Vision put up this chart years ago that shows M2 versus Bitcoin, and it's been almost dead on at all the bottoms and tops. Once we would be through Fed interference and the Fed is easing, of course, that's good for Bitcoin. But in this period of risk off, I would say it would hurt stocks. Ethereum differs from Bitcoin. Actually, Ethereum was initially a fork of Bitcoin, by the way, but with an added feature, which is smart contracts. So what they wanted to do on Ethereum was to say, let's use blockchain technology, not just to store value, but now to store information. Ethereum is as a smart contract platform actually also has something called the EVM, Ethereum Virtual Machine. So you can run entire programs and conditional contracts on Ethereum. And Ethereum itself is 100% reliable. It has not had a single moment of downtime since inception. It's one of the few blockchains that has never been down. And then if you needed to do more things on Ethereum, you can build what they call layer 2s on top of it. So Ethereum is essentially infrastructure that now is catching the attention of two industries. The first is the financial sector. The stable coins became really viral, a breakaway product for crypto, and that's like the ChatGPT moment. There's $250 billion worth of stable coins. The vast majority of those are minted on Ethereum. Then the Genius Act was passed by this administration and this Congress, and that greenlighted the proliferation of stablecoins onto the blockchain. So banks are now building stablecoin products. That Treasury Secretary Bessent thinks that could get to 4 trillion. That's exponential growth, burning gas on Ethereum. And then we have Project Crypto, which is the SEC wanting Wall Street to build on the blockchain.
Bitcoin remains closely correlated with global monetary liquidity. In fact, Raoul Pal of Real Vision has shown a near-perfect correlation between M2 money supply growth and Bitcoin's price at both tops and bottoms of cycles. When central banks ease, Bitcoin tends to thrive. When central banks tighten, Bitcoin struggles. So in the near term, Bitcoin's path will depend heavily on Federal Reserve policy and global risk appetite. In a risk-off environment, Bitcoin might move alongside equities to the downside. But once liquidity turns and easing begins, Bitcoin has historically been one of the best performing assets.
All that collectively, from a Wall Street perspective, is like 1971 for the dollar. And what I mean by that is, in 1971, the dollar went off the gold standard. So in 1971, the dollar became synthetic. And gold was what people bought as a hedge against that synthetic dollar. So you had gold as the trade, and that would be the Bitcoin equivalent. But actually, the synthetic dollar is what created the rails for Wall Street to build all their future products. The futures, curves, derivatives were all because the dollar was a synthetic product. If the dollar was backed by gold, Wall Street would be still a very small business. Well, Wall Street now is going to be building its entire infrastructure onto the blockchain. And the blockchain they're choosing is Ethereum. So this is the 1971 moment where Wall Street is essentially capitalizing on tokenizing the entire world onto a blockchain. That's a huge opportunity. The narrative of storing value is really Bitcoin's use case. Ethereum's use case is that it's actually going to be used and burned. So Ethereum gets consumed through gas fees, and then staking is how you produce an Ethereum. That inflation rate has been below Bitcoin, actually. So if you look at it as monetary supply, Bitcoin's monetary supply is actually still growing faster than Tether created the first dollar stablecoin, and they built it on Ethereum. Their idea was someone doesn't always want to be long Bitcoin or another crypto. They want to be long something stable. And crypto holders weren't really allowed banking access, so they didn't have an off-ramp. So Tether built a dollar-backed coin called a stablecoin, USDT. In 2017, Google and the UT Austin wrote these papers claiming Tether was just a fraud. And the only reason crypto went up was because of Tether creations. Okay, so in other words, it was immediately tried to be viewed as something fake. But then Tether has since grown, and of course stablecoins have really grown in popularity. Merchants outside the US love stablecoins because they don't suffer the chargebacks. You know, credit card companies merchants eat fraudulent transactions. So merchants, they get paid, it's just as good as getting a dollar. In Turkey and a place like India, Tether trades at a premium to the dollar because people prefer to get that over cash because it's hard to get robbed. You know, you can use a stable coin to buy real estate in Dubai now using Tether, like $100 million transactions. So it's actually being used in the real world. Actually, stablecoin usage, 80% is outside the US. But the reason the US administration starts to like it is, number one, crypto is essentially 100% quoted in dollars. In GDP terms, the dollar is 27% of global economy. It's 55% of central bank reserves is the dollar. It's 80% of traditional financial market pair quotes. So the synthetic dollar, which happened in 1971, made the dollar 80% dominant. In the crypto world, the dollar is 100% dominant. So the US wants us to financialize into crypto because everybody prefers to get a dollar. Collectively, the stablecoin industry is about 280 billion of outstanding dollars. They are now the 12th largest holder of treasuries in the world. Japan owns 1.2 trillion of treasuries. Treasury Secretary Bessent thinks this market will get to 4 trillion. That would make stablecoins the largest holder of treasuries in the world. So it'll be backstopping the entire treasury market.
Bitcoin, Ethereum, and stablecoins aren't isolated phenomena. They're part of a single story, the digitization of money and finance. We are witnessing the early stages of a transformation as profound as the shift off the gold standard in 1971. The difference is, this time, the rails are global, decentralized, and accessible to everyone.